Hello and welcome to video 15 of the Licensing Education Series by AIC, a partner of American Senior Benefits. Please watch each video all the way through once without taking notes and then go back and take notes. You'll find that you retain more information that way. If there are any topics you'd like me to do a deeper dive into, please comment and tell me the specific information you want me to go over. Thanks for attending and let's get started. Okay, so today is about long-term care, also known as custodial care. This section only has 5 questions on the exam, so go over it, but don't waste a bunch of time on this topic. Alright, so long-term care or custodial care is not usually medical in nature. It usually involves assistance with personal needs or activities of daily living in a home, assisted living, adult daycare, or in a nursing home. 70% of the people over 65 are going to need some type of long-term care. And the cost of it is very high. Here in Tulsa area, it's about $43.50 per month. Nationally, it's higher than that. It's around $6,000 per month, and that's for a semi-private nursing home room. If a person wants private, add another $1,000 or so onto that number. Home health care, so that's for a facility. Home health care is about $20 to $30 per hour. Now, there are 3 ways to pay for this custodial type of care. You can have lots of money, so you can be rich and pay for it. You can be no money, so go broke and go on Medicaid. Or you can get insurance. So, who exactly needs long-term care insurance? Basically, anyone who's concerned with their cost of care and has assets to lose. So, if a person's already poor, if they already don't have money, they usually don't need long-term care insurance because there are social health insurance options like Medicaid. Now, back in the early days of long-term care, each company came out with its own flavor of coverage. Some were very restrictive to qualify for benefits or didn't cover certain conditions like Alzheimer's. Eventually, the National Association of Insurance Commissioners, which is the NAIC, they developed a model for these types of plans, and most states have adopted the model. However, since each state regulates its own insurance rules and laws, they don't have to adopt it if they don't want to. So there are qualified plans, and there are non-qualified plans. If you remember back to an earlier video about insurance, about annuities especially, we talked about qualified and non-qualified. Qualified means there's some kind of favorable tax status. So with these, if the policy is qualified, it meets certain federal standards, and the policy premiums may be deducted from federal income tax and possibly from the state tax if the state allows it. The benefits are also usually received tax-free. If you purchase a non-qualified plan, then they wouldn't get those tax benefits. Now, most long-term care policies are guaranteed renewal. Which means that as long as the individual pays their premium, they can't be canceled. Now, they can have a rate increase, but only if everyone that has a policy is also getting an increase. Rarely, a long-term care policy may be non-cancelable. which means that not only can the insurance company not cancel the policy for any reason other than non-payment of a premium, they also can't change anything about the policy or have a rate increase. Also, most long-term care policies have a waiver of premium. This means that if the individual goes on claims, after some set number of days on claims, they will no longer have to pay premiums for the policy to keep it in force. Hospice care and respite care are also usually in the policies. Hospice is care for terminally ill individuals, and respite is like a vacation for the primary caregiver, who's usually a family member, for a short time. So benefits for these policies are calculated using three things: an elimination period, which is a time-based deductible. You'll see a lot of like 30-day or 90-day elimination periods, but it can be other numbers of days as well. A daily benefit, that's usually somewhere between $50 and $300 per day, although some companies offer even higher amounts. And a multiplier. The multiplier can be based on the number of days in a year, like 365 or 730, 1095, etc. Or it could be some other number like 500. So if you see a policy or a client tells you perhaps they have a 2-year plan, it actually usually means that it has a 730 multiplier. So to calculate one, let's say the individual has a 3-year plan with $100 per day in daily benefit and a 90-day elimination. And so the way you figure this is you take 3, so 3 years, right? 3 times 365, that equals 1095. And you multiply that by how many day or how much per day they have in coverage. So it'd be 1095 times 100, which is 109,500. So after the client qualifies for claims, they pay 90 days out of pocket for their care, and then they would have access to $109,500 of care. But it's no more than $100 per day of care. But it could be less. So it'll last however long it lasts at $100 or less per day. So the minimum it'll last is 3 years. So if they used $50 per day for 7 days a week, then the plan would last 6 years. So that's why you can see that saying 3-year plan is sometimes a little off, and why using a multiplier is better, because this could last anywhere from 3 to however many years the person lives. It just depends on how much they use it. So if the person used $200 a day, it would still last 3 years because only 100 would come from the policy, the other 100 would come from their pocket. So these plans may cover facility only, which is nursing homes and assisted living. It could cover home health care, which usually includes adult daycare. Or it could be comprehensive and cover both. The plans also probably offer some form of inflation protection. That might be in the form of an automatic percentage increase in coverage each year, or it could be the option to buy more coverage in the future without having to qualify through underwriting. Now, in order to qualify to receive benefits from a long-term care policy, the individual has to have a triggering event. For most plans, it's either a functional trigger or a cognitive trigger. So the functional would be something wrong with your body, cognitive would be something wrong with your mind. The functional triggers are called ADLs, or activities of daily living, and there are 6 of them in most plans. The easiest way to remember what they are is to imagine waking up in the morning. When you first wake up, you hope you didn't do this in bed. Well, most people hope they didn't lose control of their bowel or bladder. Now, if you were able to control it, it's called continence. The opposite would be incontinence, or being incontinent. Now, the first thing after you wake up and you're still dry is what? Well, you get out of bed and walk somewhere. So moving from one place to another is called transferring. Where are you transferring to? Well, I transfer to the bathroom. And what do you do in there? You do toileting. Now, toileting is not going to the bathroom. It's actually the old-fashioned use of the word toileting, which means personal hygiene. If you go to a drugstore, you might see a section called toiletries. Those are the things that you use for toileting. So after I do my brushing my teeth, shaving, next I would go ahead and jump in the shower. Possibly you would take a bath. That's called bathing. However you're cleaning yourself. Then after the bath, I go ahead and get dressed. So dressing. And then I head to the kitchen, or more likely to Mickey D's and grab some food, and that is eating. So the 6 ADLs are continence, transferring, toileting, bathing, dressing, and eating. They will throw in sometimes they'll say like cooking or walking, something like that. Make sure you're actually following this 6 ADLs. You don't have to be able to cook to eat, for example. Now, you may find variations on these 6, especially in older policies, but these are usually the ones that are used these days. Now, a cognitive trigger involves the individual's inability to mentally be able to take care of themselves. Now, that could be from a stroke, Alzheimer's, traumatic brain injuries, dementia, whatever. In some policies, there also might be an additional one called a medical necessity trigger. That covers needs that are triggered by a medical event, and usually your doctor certifies that. So long-term care policies have become so expensive and hard to qualify for through underwriting that many people are looking for other options than traditional long-term care insurance. And some life insurance policies or annuities may have long-term care riders or some kind of long-term care benefit, and those are becoming more and more popular. So that's the basics of long-term care insurance. Again, don't stress too much over this section. Go over it, but only spend a lot of time on it if you've already studied the bigger sections thoroughly. All right, so the next video is going to start on provisions, options, exclusions, riders, clauses, and rights. This information, there's a lot of it. It's broken up. So please like and subscribe so you get notified when new educational videos are released, and thanks for watching.